The Due Diligence Playbook for business investors. There's a lot of talk about the silver wave, the flood of baby boomer-owned businesses hitting the market as their owners look to retire. It's creating a once-in-a-generation opportunity for acquisition-minded entrepreneurs and investors alike. But here's the truth that doesn't get talked about enough. Not all these businesses are good. Some look great on paper, but fall apart under pressure. Others don't reveal their true potential or risks until you dig far beneath the surface. That's where smart money separates itself. The most successful investors don't just buy financials, they buy leadership, systems, and long-term resilience. Financial health. Beyond the obvious, standard financial statements reveal history, not future potential. I always examine customer concentration first. A business with one client, representing 40% of revenue, shows vulnerability despite strong financials. Similarly, recurring revenue models create stability that one-time sales cannot match. The cash conversion cycle often reveals liquidity issues hidden behind impressive revenue figures. How quickly can the business turn sales into actual cash? Two companies with identical EBITDA can represent vastly different investment opportunities when one requires constant capital expenditure while the other operates with minimal reinvestment needs. The quality of earnings matters tremendously. Normalized EBITDA strips away one-time events, owner perks, and aggressive accounting to reveal true profitability. Off-balance sheet liabilities like guarantees, lease obligations, or pending lawsuits can materially impact valuation despite never appearing in standard reports. Leadership that scales. Three qualities consistently predict leadership success: strategic clarity, coachability, and depth beyond the founder. Great teams share a clear vision that keeps execution focused. Coachability signals whether leaders can adapt as the business scales or markets shift. The strongest businesses build leadership benches with empowered operators who can sustain growth even without the founder. When a charismatic founder dominates every decision, the business becomes fundamentally less valuable. Sophisticated investors look for organizations, not personalities. Sustainable competitive advantage. Sustainable competitive advantage is best revealed not through flashy growth metrics, but through a business's grip on its market. One of the clearest indicators is customer stickiness, when leaving the product or service feels inconvenient or risky. I assess this by analyzing switching costs, such as platform integrations, employee retraining, and contractual obligations. But numbers only go so far. The most telling insights often come from direct conversations with customers and competitors. Suppose customers say they'd stay even in the face of lower-cost alternatives, and competitors admit winning them over is difficult. That's not luck in that case, it's a genuine moat. Scalable businesses build systems, not just outcomes. I look for process repeatability through documented, standardized workflows that don't rely on specific employees. Technology infrastructure should reduce manual work and enable automation as volume increases. The critical test is whether the business can handle increased volume without compromising quality. Growth will only expose deeper inefficiencies if customer experience degrades as demand rises. Hidden risk factors. The most dangerous threats rarely appear in financial statements. Dependency risk lurks when businesses rely too heavily on single clients, vendors, or marketing channels. Cultural risk manifests through employee turnover, eroding morale, and inconsistent execution. Teams without clear decision-making frameworks often falter under pressure, making reactive choices or deferring entirely to founder instincts. These factors determine whether a business weathers storms or unravels under stress. Exit strategy alignment. Savvy investors think about exit paths from day one. This forward-thinking approach shapes everything from financial structure and leadership development to contract negotiation and risk management. Whether planning for a strategic acquisition, private equity transaction, or internal succession, aligning operations with potential buyers' perspectives creates substantially more value. Common investment mistakes. Even sophisticated investors make avoidable errors. Many overvalue financials while undervaluing people, forgetting that strong teams can fix weak numbers, but rarely the reverse. Others assume past performance predicts future results without stress testing the business model against changing market conditions. Rushing due diligence in competitive deals leads to costly post-acquisition surprises. The most dangerous mistake involves getting swept up in a founder's compelling vision without asking whether the business would thrive under different leadership. The best investors remain disciplined, curious, and willing to challenge even the most polished presentations. They recognize that what matters isn't what appears impressive today, but what creates sustainable value tomorrow.